Corporate Finance OneNote Practice Problem. In this presentation, we will work a practice problem in OneNote related to balance sheet and income statement classifications. Get ready, because it's time to take a stance with Corporate Finance. Here we are in OneNote. If you would like to follow along in OneNote, you're not required to do so, but if you have access to OneNote and would like to, we are in the section 224, Balance Sheet and Income Statement Classification in tab Practice Problems. Closing this back up, we're going to have our information up top, which will be the classification of accounts into either balance sheet accounts or income statement accounts. That's going to be our first classification that we will be putting into place. Then we will further classify, focusing in on the balance sheet classifications for current assets, fixed assets, current liabilities, long-term liabilities, stockholders' equity, and then none for everything else, including the income statement accounts. So our focus here is really going to be on those balance sheet accounts, and we want to compare and contrast them to the income statement accounts. We're going to keep on putting together and building in on the concepts of the balance sheet until we actually construct a balance sheet or put one together from the set amount of information so that we can be comfortable with looking at the balance sheet, remembering that from a finance perspective, we're going to be looking at the balance sheet for decision-making purposes, running analysis on it. So we need to know what it is, how it's been constructed, how we can use it for decision-making purposes, as opposed to how we might see it from an accounting perspective, in which case we're focused a lot more on the building blocks, going all the way back to individual transactions, building the GL, building the trial balance, building then the financial statements, including the balance sheet and income statement. We don't have to go back that far for finance because our main goal is decision-making processes. So what we need to do is dig down enough to fully understand what the balance sheet is telling us, what are the components of the balance sheet, and then how can we use those components for decision-making processes. We will build up in those components by working on concepts related to the balance sheet, then piece by piece putting the balance sheet together until we put together, the full balance sheet here. Remember, when we think about the balance sheet, we're thinking about the accounting equation, the double entry accounting system itself. The balance sheet is encompassing all of the double entry accounting system in an accounting equation of assets equal liabilities plus equity. Assets represent what the company has. Liabilities and equity represent who has claim to what the company has. That's how an accountant typically looks at the accounting equation, because they're two sides of the same coin. Assets are what is owned by the company. Liabilities represents a third-party claim to those assets. Equity represents the owner's claim to those assets. From a finance standpoint, we often, or more often, represent the accounting equation as assets minus liabilities equal equity, because that emphasizes the fact that the equity, it's the same equation, of course, just algebraically, we'll just change it algebraically to assets minus liability equals equity, which emphasizes the fact that equity is the book value of the company, the net assets. That's kind of if you were to take one number and say, hey, this is where we stand right now, you'd pick the equity number because it represents assets minus liabilities. Then you would next ask, well, how did they get there? What's the performance? How did they do last year? And therefore, how might they do next year? For that, you would need then the income statement. So then we can further classify down the balance sheet into under assets. These are classifications, not accounts. Further classification, current assets versus fixed assets. Current assets being those that are going to be more liquid, things that we're going to be more readily transferable to cash or something that will be consumed shortly in the production of the goal of the organization, revenue generation. Then we have the fixed assets, representing long-term assets, depreciable assets. They might be called property, plant, and equipment assets, fixed assets, depreciable assets, PP&E, property, plant, and equipment. Could be other names for this. These are long-term assets like buildings, equipment. These are things we cannot use to pay off the short-term debt. They are there in order to help us generate revenue in the future, but they're not things that we can easily just basically use to sell or pay off debt with. And so that's why we need to make this breakout. Then we got the current liabilities and long-term liabilities. Once again, account categories. These aren't actual accounts. These are the categorizations. Current liabilities represent those that have an arbitrary cutoff of 1 year. We said 1 year out. If they're due within a year, they're going to be current. We want to have that cutoff because those obligations are going to be due soon. and therefore we're going to have a comparison from a finance perspective of the current liabilities and the current assets, and even more liquid assets than that, possibly even cash, because we're thinking about, do we have the cash to pay off the liabilities that are going to be due in a year, or is all our money sunk in fixed assets to the point that we're not going to be able to pay off our current obligations, in which case we'll have problems, right? So that's going to be one of the major comparisons we'll be looking at for liquidity from a finance perspective. Long-term liabilities represent those that are going to be longer term. So they're going to be things that are due, but they're not due until after a 12-month time period. So in that case, we can compare current and long-term current assets and current liabilities. And if there's a problem there with the current liabilities, we could make it a long-term liability possibly, and at least just, push out the problem for a little bit of time so that we can meet our current obligations, right? So we want to know current liabilities, long-term liabilities, equity then representing the owner's interest in the company, owner's claim to the company. We're focusing in on corporations where that equity section is then broken out into standardized chunks. So we'll typically break out the equity section then in terms of the investments from the owner into the company, and then the retained earnings, the earnings that have accumulated but that have not yet been distributed out. So that means we're going to have the common stock and additional paid-in capital representing the investment of the owners, and then the retained earnings representing the earnings in the company that have not yet been distributed. Okay, similar process down here. We're going to go through our list of accounts, and we're going to compare them in those two kind of formats. So we have the accounts receivable. So first off, is accounts receivable an asset, liability, equity, or is it an income statement account? It's going to be an asset type of account because it's a receivable. It represents something that people owe to us. That usually is going to be put on the books from a sale. If we do what we do when we sell, either a service or inventory, we're going to increase the receivable. If we sold it on account, the form related to that would typically be an invoice. So balance sheet account, it's going to be a current asset account as well because we typically expect payment within 30 to 60 days. So we're going to say that'll be balance sheet current. Retained earnings, where's retained earnings? Asset, liability, equity, or is it income statement, revenue, or expense account? Retained earnings is typically going to be on the balance sheet. It's going to be an equity type of account. It's going to be within the equity section. Recall that the equity section represents the owner's claim to liabilities and to the assets. Owner's claim to the assets. And the equity section will be broken out into the investments that the owner put in, which will be common stock and the additional paid-in capital, and then we'll have to deal with preferred stock, but that's the main category. And then you got the retained earnings, which represent the earnings that have accumulated that have not yet been distributed in the form of dividends. So that's going to be balance sheet, stockholders' equity. Then we got the income tax expense. So it says here it's an expense, right? So anytime we see expense and not expenses, like prepayment expenses or something like that, it's an expense. So is that an asset, liability, or income statement account, which includes revenue and expense? It's going to be income statement account, revenue and expense. So it's going to be a typical kind of expense. It'll fall on the bottom of the income statement because of the categorizations, but it's going to be an expense on the income statement. So we're going to have income statement none because the categories that are listed here are all the balance sheet categories. So anything income statement related will not be included. Cash. Is it an asset, liability, equity? It's going to be an asset account. It's going to be our first asset account. It's a very liquid asset account. Therefore, it will be a current asset. Don't get cash mixed up with revenue. They're not the same thing. Revenue represents us earning something. Cash represents the form of payment. We usually get paid in cash for what we have earned. However, we could get paid in some other way, and we may not get the cash at the same point in time that we earned it. We may have account receivable until we get the cash. So that's going to be actually, I wasn't on cash yet. Accrued expenses. Accrued expenses, so is that going to be an asset, liability, equity, or income and expense? Accrued expenses sounds like an expense, but it's not an expense. It says expenses. They're things that have accrued upwards, and therefore it's actually going to be a liability. It's an expense that has accrued that has not yet been paid. So something has an obligation is accruing upwards, and we have not yet paid it with cash. Therefore, we owe it in the future. So it's going to be a liability. Typically, those types of expenses that have accrued will be short-term. In other words, they will be due within a year, and therefore they're going to be current liabilities. Then cash So we have the cash there as well we took a look at, and then we have the selling and admin expense. So now we have an expense, so we have the name expense. That's going to typically be, what is it, asset, liability, equity, income, or expense, or the income statement account. It's going to be an income statement account. It's going to be an expense category on the income statement. Remember, when you think of the income statement, you can really think of it as breaking down into two categories, income and expenses. We broke them out into subcategories, subgroups, to get to those stops along the way. But really, they're typically going to be just income and expense. So we have an expense on the income statement, therefore not a balance sheet account. So it's going to be income statement and none, because our accounts are going to be the balance sheet accounts there. So we're going to have the plant and equipment. Where does that lie? Is it an asset, liability, or equity? That's typically going to be an asset type of account. We're talking about things like building, car, machinery, and whatnot. Even if we pay cash for those things, we don't expense them at the point in time we purchase them, because they're long-lived things. Therefore, they're going to be on the balance sheet as an asset, and we will expense them, allocating the cost in the form of depreciation. We will depreciate them. Now, they're not going to be current because they're not going to be liquid. They're not things that are close to cash. We're not going to use them shortly. We can't use the car, the building, or anything like that to pay off debt. We have it in order to generate revenue in the future. The revenue is going to pay off the debt, hopefully, but not the car itself, or the building itself. So it's going to go into the fixed assets. Remember, fixed assets could be property, plant, and equipment. You might be hearing them called that, or shorten that to PP&E. They might be called depreciable assets because they're going to be depreciated, although land falls in there as well. Land's the exception to depreciation because land doesn't deteriorate in value, at least in human lifetimes, typically, and therefore it's not going to be depreciated. So it might be called fixed assets, property, plants, and equipment, machinery and equipment, or depreciable assets. And then that's going to be that one. Then we have the operating expenses. Operating expenses is kind of like a subcategory that we had, but once again, and it says expenses instead of expense, so it's not like naming one account. It's really naming a category. Is that category on the balance sheet or income statement? It's going to be on the income statement. It's summing up one categorization of the expenses during normal operations. Therefore, nothing on the balance sheet is going to be on the income statement. Therefore, we're not going to have one of our other categorizations, income statement account. Market securities. So when we think about market securities, you might think of our securities like to other people. You know, if they own the stock in our company, if we're talking about a company, that would be like a security. But that's not what we're talking about here. We're talking about us, the company, owning market securities in other companies. In other words, we, the company, this company owns the stock, securities possibly in the form of possibly stock in another company. So to us, then, that would be an investment. If we had marketable securities, we would take some of our cash. We're going to park it somewhere to hopefully get some short-term return on it until we use it in the business. That means it's going to be an asset, typically going to be a current asset. So we're going to say current asset on the marketable securities. Then we have the interest expense. So this is an account, and it's an expense account. So therefore, is it going to be an asset, liability, equity, income, or expense account, or is it on the income statement or balance sheet? It's going to be an income statement account because it's an expense. Income statement has revenue and expense accounts. Note that we run into a lot of expense type of accounts, not many revenue type of accounts, and that's because the company will specialize on one thing, right? So the revenue hopefully will be higher than all the expenses from a dollar perspective. However, there's going to be less revenue accounts than expense accounts because we pay for a variety of things to have done for us as we go towards our goal of revenue generation, where we focus in on one thing. Expense account, though, therefore not a balance sheet account, income statement, and then no further categorization because we're categorizing balance sheet accounts. Sales, where does sales lie? Is it going to be an asset, liability, equity, income, or expense, or is it balance sheet or income statement? Sales typically going to be income statement. Why? Because it represents a revenue type of account. When you think of revenue, when you think of the income statement, you have income and expense. The term you want, the type of account you want to think about, like asset, liability, and equity are types of accounts, is typically revenue. And then the account name could be something other than revenue, such as sales. So sales is a revenue type of account, like cash is an asset type of account. And then it could be called fees earned if you're a law firm. It could be called income. So just keep that in mind. But we're going to say sales, income statement account. No further categorization because we're focusing in on the balance sheet. Then we have the notes payable. Notes payable in 6 months is the due date. Asset, liability, or equity on the notes payable. So it's a payable. Whenever we hear payable, that means that's like bad to our ear normally. We owe something, right? It's a payable. So that's going to be a liability typically. So we're going to say it's a liability. It's a note payable. Now a note payable, note if it's a accounts payable, it will almost always be short term because account payable represents something that we purchase typically in the normal process of business and therefore pay off normally within 30 to 60 days or something like that. However, notes payable usually represents like a loan that we took out possibly from the bank. And it could be short term or long term or both because if you think about a normal loan, like a car loan or to finance a car or a home, we often pay that off monthly with both principal and interest components to those payments. Therefore, if the loan extended beyond a year, we could have a short-term and long-term portion of it. However, other types of loans may not be that way, right? We could set up the loan to have only interest paid and then we pay it all back at the end, or just have some balloon payment at the end. And if the loan is going to be due within a year, because the current and long-term cutoff is simply a year, then it'll be short term. This was due within 6 months under the cutoff of 1 year. Therefore, it's going to be a current liability. So we're going to say current liability on the note payable. Then we got the bond payable, another type of payable account. Is it going to be a asset, liability, equity, or income statement, revenue, or expense account? That will typically, once again, be a payable, therefore liability type of account. Bonds payable, you want to think if it's a payable, that it's similar to a note payable. We needed money. The company needed money. A couple ways they can get money. One, they can try to issue more stock, but when they do though, they're issuing voting power in the company. They're giving away equity. People are influencing the decision-making process in some way. Whereas if you take a loan, you can either take a loan from the bank, which would be like a note payable, or possibly you can issue bonds where you might be able to issue bonds to a broader, scope of the market, and then you'd have bonds payable. The bonds payable will typically be a little bit different because usually the bond payable pay back interest. We get the money and then we pay back the loaner of the bond interest typically until the maturity of the bond, in which case we pay back the principal of the bond. Therefore, the principal time period might be long term, and unlike a normal kind of loan where we pay off some principal and interest as we go, it will all be principal basically at the end. Therefore, it could all be long term. So I would say long term unless the maturity date was within a year, in which case the problem would typically tell us that. So I would default to long term with the bond payable. Then we have the common stock. Is it going to be an asset, liability, equity, or an income statement account, balance sheet or income statement account for the common stock? Typically balance sheet account. It's going to be under the equity section. It's a common stock represents the company issuing common stock, meaning that that's going to be the initial investment of the owners. That's going to be an investment of the owners into the company in exchange for that equity investment, in exchange for that voting power and the right to get shares of dividends whenever dividends are going to be distributed for them. So common stock is going to be within the equity section. Remembering the equity section will typically be broken out in a corporation to what was put into the company, which will be common stock and additional paid-in capital, and the earnings that have been retained and not given back out, that being retained earnings. Depreciation expense. Is that going to be a balance sheet account or income statement account? It's an expense. It says expense in the name again. So that would typically be an income statement account, revenue and expenses on the income statement. Depreciation representing the allocation of the costs for the long-term assets, the fixed assets that we're going to be allocating over the useful life of the assets. We will do so in the form of depreciation expense. So income statement account, no other item here. Inventory, is that a balance sheet account or income statement account? Inventory is typically going to be a balance sheet account. That's stuff that we sell. So we bought something in order to resell it. What is inventory? Well, it depends on our intention. Different things could be inventory to different companies. If our intention is to buy it, mark it up, resell it, generate revenue based on the sale of the items we have. That basically would be the inventory. We put the inventory on the books as an asset when we buy it, even if we paid cash for it, which is an accrual concept. Then we're going to take them off the books when we consume the inventory, using the inventory in order to help generate revenue and in the form of cost of goods sold. But when we buy the inventory, asset on the books, going to be a current asset because we hope to sell it soon, and so we hope it's going to be fairly liquid. Then we got the capital in excess of par. Capital in excess of par, or otherwise known as additional paid-in capital. Is that going to be a balance sheet account or income statement account? It's actually going to be balance sheet. It's going to be in here with the equity section. That's the most strange kind of account other than the preferred stock, because it's related to the common stock. We're basically breaking out the common stock. So remember that when we issue the common stock, we're going to issue it for whatever we can issue it for, the market price of the common stock. However, we're going to set a par value so that we can standardize the common stock, so that the common stock relationship between the par value and the amount that's recorded in common stock, it will be standardized. And then any additional amount we're going to put into additional paid-in capital. So these two accounts, you lump them together as basically the investment of the owner in the company, breaking them out to and opposed to the earnings that have been retained that are not there from the initial investment in the form of retained earnings. And then distributions will typically come from the retained earnings before they come from the initial distributions, is how we want to think about the money going out then. So that's going to be the balance sheet, stockholders' equity. How about net income? Is that going to be a balance sheet account or income statement account? So that should ring a bell. That's the bottom line of the income statement. So that's kind of like the bottom line with a double underline under it. There's like a double underline under that one in the income statement. So that's on the income statement. It's not an account. It's going to be a categorization, basically that little bottom line of the income statement. So income statement. Then we have the income tax payable. So we haven't really looked at income tax payable, but we hear the word payable in it. So we've seen income tax. So you might be thinking, well, we calculated tax on the income statement, but that was tax expense. The payable means we accrued the expense, have not yet paid it, and therefore we owe it to the government. So it says payable, therefore it's going to be a liability, balance sheet account, liability account. Typically, when we put the payable on the books, it's because we owe it within a year's time period. Therefore, it's going to be a current liability that we owe to the government. So we have the balance sheet current liability.